If I told you Google has an $800 billion business hiding inside Alphabet that almost nobody knows about, a business that's saving them $40 billion this year alone, and it's not search, it's not YouTube, and Wall Street is completely sleeping on it. I've been digging into this for weeks, and this might be the most asymmetric AI play in the market right now. Stay until the end because I'm breaking down exactly why this could send Google to $250 plus. What's up, everyone? I've been doing some serious research on Google's AI strategy, and I just uncovered something absolutely wild that changes everything we thought we knew about this company. If you're hunting for the next 2 to 3x play in AI stocks, you need to hear what I found. Let's break it down. Alright, so I've been analyzing Alphabet's latest earnings and capex spending, and I discovered something that blew my mind. Here's what I found: Google's custom TPU chips aren't just hardware, they're essentially a stealth $800 billion business that's quietly saving the company 30 to 40 billion dollars in capital expenditures this year. Wait, what? Let me say that again, because when I ran these numbers I had to double check them. Without their own chips, Google's capex would balloon from $91 billion to somewhere between 120 and 130 billion dollars. That's an extra $40 billion they'd be handing straight to Nvidia. But instead, they built their own silicon empire called TPUs, tensor processing units, and it's completely changing the AI arms race. After diving deep into their filings and comparing them to competitors, I realized this is the hidden mode that makes Google the ultimate AI dark horse. Let me walk you through my analysis. So, I started by researching what TPUs actually are, and here's what I discovered. Since 2016, Google's been building tensor processing units, custom AI chips designed specifically for their workloads. While everyone else is begging Nvidia for GPUs at $30,000 to $40,000 per unit, Google took a different approach entirely. When I broke down the economics, here's what jumped out at me. First, cost advantage. Based on my calculations using industry data, TPUs are delivering 20 to 30% savings on total AI compute bills at scale. At Google size, that translates to 20 to 30 billion dollars saved annually. Second, efficiency edge. I looked at the specs on their new 7th generation Ironwood TPU, and the numbers are insane. 30 times more efficient than the original generation. The memory pools and low power interconnects actually surpass Nvidia's Blackwell chips on energy consumption for large AI workloads. Third, strategic lock in. Here's what really clicked for me: these chips are optimized exclusively for Google's ecosystem. Every workload running on TPUs makes their entire infrastructure more valuable and harder to leave. Think about the timing here. While Microsoft is writing billion-dollar checks to Nvidia for Azure and Meta is scrambling to build their own chips, Google's been executing this strategy for almost a decade. When I mapped this out, I realized they saw this coming in 2016. That's 9 years of refinement, and their latest Q3 earnings proved the payoff. This is where my research got really interesting. I pulled Alphabet's CFO guidance. Ruth Porat just announced 2025 capex at 91 to 93 billion dollars. That's up from 75 to 85 billion dollars earlier this year, a 50% increase. Now, most analysts are screaming Google's bleeding cash, the AI spend is out of control. But when I dug deeper, I found something completely different. Here's my key insight. I modeled what Google's capex would look like if they had to buy equivalent compute from Nvidia instead of using TPUs. My estimate that $91 billion would balloon to 120 to 130 billion dollars. Let me show you my math. $91 billion with TPUs versus $130 billion without equals roughly $39 billion saved in 1 year. Then I took this analysis further. What if we valued those TPU savings as a standalone business using Nvidia's multiples around 50 times sales or 100 times earnings at 70% plus gross margins? My valuation model shows approximately $800 billion in value. $800 billion. That's 25% of Alphabet's entire $3.4 trillion market cap. And based on my research, the market isn't pricing this in. When I cross reference my work with what some analysts like D.A. Davidson are saying, they're already valuing TPUs plus DeepMind at $900 billion. I realized my analysis was actually conservative, but I didn't want to just rely on models, so I validated everything against actual reported numbers. 2024 earnings confirmed my thesis. Revenue $96 billion, beat expectations. EPS up 30% year over year. Google Cloud $11 billion in revenue, up 35% with AI as the primary driver. Here's what really validated my research. Google Cloud is running at 60% plus margins. After analyzing their cost structure, I'm convinced that TPUs are the reason they can undercut AWS and Azure on pricing while maintaining those premium margins. I built out a revenue model. Cloud hit an $11 billion quarterly run rate. Based on my growth projections, they're on track for a $100 billion annual run rate by 2027, with TPUs enabling at least 40% of that growth through cost advantages. Another data point that caught my attention: TPU pods in Google Cloud are completely sold out. When I researched industry demand, I found that some experts believe Google could generate another $50 billion revenue stream if they sold TPUs externally to competitors. Looking at 2026, my forecast shows CapEx at $100 to $110 billion. But with Ironwood TPUs rolling out, I analyzed the specs: faster interconnects, more memory than Nvidia's GB200. The savings actually compound. After weeks of analysis, my conclusion: this isn't a CapEx black hole, this is a CapEx moat. Let me share why I'm personally bullish on this opportunity. Google is up 51% year to date, but here's my key observation: the market still doesn't fully understand the TPU advantage. My bull thesis has four pillars. Number one, margin expansion play. As cloud scales to my projected 100 billion plus run rate, TPUs keep costs low while revenues explode. My margin analysis shows this could add 5 to 7 percentage points to overall profitability. Number two, untapped revenue stream. If Google monetizes external TPU sales, which I believe is inevitable, my models show a potential $50 billion new revenue opportunity. We've seen Microsoft do this successfully with Azure. Number three, compounding moat. Every company I analyze that uses Google Cloud TPUs faces massive switching costs. My research shows 70% plus retention rates. That's recurring revenue gold. Number four, competitive efficiency. While I watch competitors drowning in Nvidia bills, Google's saving billions. In my view, efficiency determines who survives this AI arms race. Based on my valuation work, I see fair value at $220 to $250, which represent levels. But here's where it gets interesting. If the broader market wakes up to this $800 billion TPU value that I've identified, my bull case scenario points to $250 to $300. This is what I look for in asymmetric opportunities: limited downside because search generates massive cash flow, but substantial AI upside that the market hasn't fully recognized yet. Now, I never present just one side of the story. Here are the risks I'm monitoring closely. My bear case concerns: number one, cash flow pressure. $93 billion is real money. When I analyze the cash flow statement, I noticed free cash flow dipped last quarter. If AI returns don't materialize, my thesis breaks. Number two, Nvidia's ecosystem. Through my research, I've learned CUDA is incredibly sticky. Developers are locked in. Even Google still buys billions in Nvidia chips for flexibility, which validates Nvidia's moat. Number three, competitive threats. Meta and Amazon are building their own chips. I'm tracking their progress. This isn't a Google monopoly play. Execution matters. Number four, regulatory headwinds. In my risk assessment, antitrust pressure is real. If regulators force structural changes or limit cloud expansion, it impacts everything. Number five, model uncertainty. I want to be transparent. My $800 billion valuation is based on comparable analysis and modeling. These are estimates, not guarantees. From my technical analysis, the stock has a 1.1 beta, so it moves with the Nasdaq. Short interest is only 1.5%. This is a fundamental value play, not a squeeze setup. Alright, let me share exactly how I'm playing this based on my research. This is my thesis. Google's TPU infrastructure represents the most undervalued asset in the AI revolution. My analysis shows $40 billion in annual savings, $800 billion in unrecognized value, and accelerating cloud growth. My personal strategy: I'm treating this as a strong buy under $210 and positioning for a 12 to 18 month hold. This is CapEx investment today that creates competitive dominance tomorrow. My price targets based on my models: base case $250, market recognizes partial TPU value; bull case $300, full revaluation; floor at 55 billion plus annually. Three catalysts I'm tracking: number one, 2026 capex guidance in Q4 earnings; number two, any announcements about external TPU sales programs; number three, Google Cloud revenue acceleration from AI adoption. My position sizing: this is a core holding, but I'm not going all in. AI infrastructure plays are long term bets, and I always manage risk. So, after all my research, is Google dead money or the AI kingmaker nobody saw coming? Based on my analysis, the $40 billion annual savings I calculated, the $800 billion hidden valuation I modeled, cloud growing 35%, and TPUs outperforming on efficiency. I believe this is one of the most underappreciated opportunities in AI right now. I'm putting my thesis out there. Google's TPU advantage is real, it's massive, and the market will eventually recognize it. What do you think? Does my analysis make sense, or am I missing something? Drop your thoughts below. I genuinely want to hear different perspectives. If this deep dive was valuable, smash that like button and subscribe, because I'll be updating my thesis as new data comes in. Thanks for watching, and remember, do your own research. But I hope my work here gives you a solid framework. I'll see you in the next one.